Welcome everyone to our fourth quarter of 2010 outlook for the major currencies. My name is Ilian Yotov. I'm the FX strategist at allthingsforex.com. Many of you are probably familiar with my name as the creator of the quarters theory. I'm an FX strategist at allthingsforex.com. I recently had a book come out called The Quarters Theory, The Revolutionary New Foreign Currencies Trading Method. I'm one of the leading educators for Forex traders in the world. I've trained thousands of traders from many countries. I'm the founder of allthingsforex.com and tradertape.com. And I also host a popular daily program called All Things Forex Broadcast, which you can find on www.allthingsforex.com. Also, if you're interested in finding out what the quarters theory is about, make sure to go check it out on my website, allthingsforex.com. I believe it's also available on fx3.com and also amazon.com and your local bookstores like Barnes & Noble, Borders, and so forth. So before we start with our outlook for the fourth quarter, let me refresh your memory as to what we did about 3 months ago on this program and remind you of some of the trends that we saw in the third quarter of 2010 and some of the questions and the factors that we were actually paying attention to in the last several months in the third quarter. The question that we asked at that point was, will the third quarter trends will the second quarter trends continue into the third quarter of 2010? And that's pretty much the same question we ask every time we are starting a new quarter. Will now the third quarter of 2010 trends for the major currencies continue into the fourth quarter? So the main question that we were asking, yes, the quarters theory, by the way, can be applied for equities and commodities. It's a theory of how prices move. To answer the question from Abel, the main question that we were asking in my previous Outlook webinar was, will the U.S. dollar get punished in the third quarter of 2010? For the Fed's accommodative monetary policy and lack of urgency from the Fed to raise interest rates, and also for the lack of fiscal austerity in the United States. So these were valid questions that we asked about 3 months ago. And anyone who's asked themselves these questions obviously has probably seen what has happened throughout the third quarter. At the time when I did my Outlook webinar for the third quarter, we had already started seeing that there was some resurgence of U.S. dollar weakness. Another question that we asked was, should we expect more risk aversion and further safe haven currency strength in the third quarter of 2010? And I also gave you what could provide the clues for things to come in the third quarter. Some of the main factors that we were paying close attention to for what could be the trends in the new quarter and what could drive the trends in the third quarter. Now, these are the 7 factors that I gave you that we need to watch for in the third quarter of 2010. Sovereign debt crisis, worldwide economic slowdown, the fiscal austerity measures that were being proposed in a lot of countries around the Eurozone and also in the United Kingdom as well, interest rates, which is always obviously important to pay close attention to when it comes to major currencies and currency exchange rates. We also noted that in the third quarter of 2010, we were going to have the results published of the European Union bank stress test. And as we do with every quarter, we started U.S. and G7 countries' corporate earnings, which obviously is important for how the equity markets will trade and will be important, obviously, for investor sentiment, risk appetite, and so forth. And then what we also said, the 7th factor was foreign exchange reserves diversification. Will foreign exchange reserves managers continue to look for other alternatives to the U.S. dollar? We know that the US dollar is the main reserve currency. Still is. But in the past decade, and in recent years as well, we have seen more of a diversification outside of the US dollar, and as foreign exchange reserves managers are looking for other alternatives. The second, of course, best alternative was the euro, and that was one of the main reasons for the euro's strength against the US dollar for the majority of the last decade. The problem is that now with the sovereign debt crisis in the beginning of the year of 2010, in the first half of 2010, the euro was not very strong. And it was not perceived as that good of a store of value, if you will, for reserves diversification. It was starting to lose its appeal as the second best alternative to the US dollar in the first half of 2010. But things were starting to shift a little bit in the third quarter of 2010. And about 3 months ago when I did my webinar for the third quarter outlook, okay, so about 3 months ago when we did the third quarter of 2010 outlook, we were beginning to notice some interesting developments. What I discussed at that time was the decline of the euro in the first half of the year, pretty much until the end of May. But in June, July, we started seeing some interesting things that looked like a short-term trend reversal. We had a bearish trend, obviously, for the euro against the US dollar. And then we started seeing a little bit of a price correction. That would be the period of the month of June. Okay, so that's normal, perfectly normal and healthy for us to see a strong move to the downside and a little bit of a price correction over here. But at that time when we did the seminar, I also brought your attention to the fact that if prices were to break higher above these recent highs that we saw in June, then that would be something more than just a price correction. And it could turn into, obviously in a midterm, if one had a longer midterm kind of a view, obviously that still is going to be a price correction, and I'll explain to you why that is later on in the webinar today. But what I was talking about is the shorter term trend developments. You had a strong bearish short term trend here, the euro going down for a number of months and weeks, and then we started seeing the actual reversal with the breakout. And at the time we did the last seminar, I said that means perhaps a longer midterm type of price correction, but it also was a short-term bullish trend reversal that the euro gave us in a month of June, beginning of July of this summer, which obviously was right at the beginning of the third quarter in the month of July. Another currency that broke and produced a bullish breakout against the US dollar was the British pound. Pretty much similar development that we saw with the euro dollar. Pound was going down and then it started breaking higher and it produced a complete short-term trend reversal. Turned a short-term bearish trend into a bullish one, and it happened exactly in the same period. Months of June and July. Another currency that continued to strengthen against the US dollar, we had a bearish trend reversal. In the first half of 2010, the dollar was trading stronger versus the Japanese yen. It even managed to reach the vicinity of 95 yen level. But in June, we actually started seeing the dollar breaking down below the 90 yen level once again. It jumped a little bit higher to about 93. However, after that, it just slowly but surely continued to grind lower in a bearish trend reversal for the US dollar against the Japanese yen in the third quarter of 2010. So is it a coincidence? Was it just one currency pair that the dollar actually broke against and then continued to strengthen against the others? No. It was across the board. And that's what I brought your attention to, that it's not an individual currency pair or an individual currency that the dollar is weakening against. It was a broad US dollar weakness that we started to notice in the beginning of the summer. Here's the dollar trend reversal, bearish trend reversal for the dollar against the Swiss franc. Again, not just an individual currency that the dollar was weak against. The dollar was strong for the first half of 2010, all throughout this period until June. And it was June when we started seeing the reversal happening. And now, of course, we have seen the dollar actually below parity with the Swiss franc with a new multi-year low as of today, actually at around 0.95 and a half. So obviously it was a broad US dollar weakening. Here's the Australian dollar also. A short-term trend reversal occurred for the Aussie versus the US dollar as well. The Aussie was trading lower against the US dollar until the beginning of June, and then we had the reversal where the Australian dollar now has reached a new record high as of today, a little bit above 99 cents, almost close, less than 100 pips now, away from the parity with the US dollar. So it was not a coincidence. It was not a coincidence, and that the US dollar was beginning to weaken. And it was a question whether or not this weakness will actually cause just price corrections or trend reversals. It turned out that these were some trend reversals with some of the major currency pairs. Now that we're starting the fourth quarter of 2010, the logical question is, will the US dollar regain its strength in a fourth quarter? We know that the bullish US dollar trend versus the euro, the British pound, and other currency majors in the first half of 2010 has obviously come to a halt in the third quarter. So what will happen with the US dollar in the fourth quarter? Here's an example of a chart that I showed you in our previous webinar. Looking ahead of the third quarter, I brought your attention to the euro actually producing that short-term trend reversal and a breakout above $24.66, $24.5 area at that point was the level of resistance. And I said, okay, so this is a short-term bullish breakout above short-term resistance level. But it was more than that. And I explained at that time what that was. It was not just a short-term bullish breakout. It was actually what I called the beginning of a midterm price correction for the euro against the US dollar. What did we mean by that midterm price correction? Now, you would recall that in June, beginning of June, the US dollar has reached a new 4-year low against the euro at the $1.1875.76 area, which is a little bit below $1.19. The dollar in the meantime has been falling since pretty much the $1.51 area. And that was a range of about, 3,200 pips, give or take, between $1.19 and $1.51. So that breakout that we discussed at the previous third quarter outlook webinar was the beginning stage of the larger midterm, midterm price correction for the euro against the US dollar. That I discussed could mean that the euro could move higher against the US dollar. At that time, from around $24.5 area, I said maybe to around $30, and maybe even above $1.30. So, here's what the euro had actually given us pretty much until now, which this chart is, by the way, from yesterday. The euro was still a little bit below $1.40. Now it reached above $1.40 level. So, will the US dollar continue to get punished in a fourth quarter? Basically, we continue to see, in other words, more of the same to what we saw and witnessed in the third quarter of 2010, which is the US dollar getting punished for the Fed's accommodative monetary policy, keeping interest rates low, and then on top of that, using quantitative easing stimulus to stimulate the economy in the U.S. And also, if I may add, for the lack of fiscal austerity in the U.S., which still is pretty much non-existent compared with governments in the Eurozone, in the United Kingdom as well, who have announced that they're going to undertake some aggressive fiscal austerity measures, debt reduction measures. The meaning of fiscal austerity is basically cutting spending and taking steps to cut the deficit and reduce the deficit of the government. October 20th, for example, is going to be an important date for the British pound, as the Chancellor of the Exchequer there, which is the Treasury Secretary of the United Kingdom, is going to lay out the plan, exact details of how the fiscal austerity measures in the United Kingdom are going to be implemented. And we had a report actually earlier today in Financial Times that they may not be as aggressive as initially thought, because the impact of them could be very, very serious. And the UK Treasury is concerned about these fiscal austerity measures, which those, by the way, are going to be the largest spending cuts and fiscal austerity measures proposed by the UK government since World War II. So obviously the concern is that they may cause a slowdown in these economies, whether it's in the UK or any of the countries in the Eurozone whose governments have taken on such fiscal austerity. So the report today in Financial Times was that the UK Treasury is working on plans to reprofile the spending cuts next April, and spread the pain, actually, not to come all at once. So we'll see the details on October 20th. So, in the U.S., we don't hear that kind of a talk. And obviously the U.S. dollar, I think one of the main reasons why the U.S. dollar is suffering also is, basically getting punished for the lack of fiscal austerity in the U.S. as the Fed is still, embarking on quantitative easing, and there's a strong potential, obviously, that the Fed could provide further monetary stimulus to the economy at their next meeting, November 2nd and 3rd. That's what the market is pricing in, and that's what we need to pay very close attention to. The U.S. economic data, especially after yesterday when we saw disappointing automatic data processing employment payrolls report in the private sector of the U.S. economy, that was not good news. It was worse than expected. We were expecting to see payrolls being added in up to 20,000 new payrolls being added in the private sector. The private sector lost about 39,000 payrolls. Instead of adding jobs, losing jobs. And that's tomorrow we have the non-farm payrolls report, obviously. It's expected the private sector to add 75,000 jobs, but if that number is worse than expected, then obviously that could increase the odds. If the UK employment reports are not showing signs of improvement, if the the US economic data continues to underperform data from the Eurozone, from the United Kingdom, elsewhere in the world, then as long as the US economy remains weak and unemployment is high, the Fed is going to continue more than likely to keep that accommodative monetary policy, to provide potentially further quantitative easing to stimulate the economy. And there will be a lack of fiscal austerity in the United States until that point. So obviously, the U.S. dollar could potentially continue to get punished in a fourth quarter. That's definitely something to watch. So yesterday when I prepared these slides for you guys, as of yesterday, the euro was rallying 18 consecutive days. 18 consecutive days, the euro rallied versus the US dollar. Today, as of today, the euro has rallied 19 days, non-stop. And it started pretty much from around this area right here. If you count the candles, this is by the way the daily chart of the euro dollar chart. You will count 18 candles. As of today, you'll count the 19th one. It was starting last night, right there when I did the slide. Now that candle has moved up about $1.40 up. 18 beautiful days, Anna says. Yes, if you're on the right side of the trade, they can be very beautiful days. But imagine the pain that euro shorts have experienced in the last 19 days, where the euro has been going up non-stop for 19 consecutive trading sessions. So what should we make of the euro's rally for 19 consecutive straight days? I think that it begs the question, is that 19-day rally of the euro against the US dollar a warning sign of a bubble? Is the euro overbought, the dollar oversold, and so forth? Is it a bubble? Or is it simply business as usual for the currency majors? And what do I mean by business as usual for the currency majors? Well, if you pay attention to longer-term trends, you would know that throughout the last decade, for the majority of the last decade, the business as usual has been US dollar weakness. So is this simply business as usual when we return to that multi-year bearish trend for the US dollar from the last decade? I think right now we're at the crossroads when we really need to find the answers to these questions. And I believe that the days and weeks ahead of us into the fourth quarter of 2010 are going to give us the clues to this important puzzle. So if you're in the bubble camp, if you're one of the traders who thinks that the euro is in a bubble, that the rally of the euro is unjustified at this point, and it's just pretty much a bubble that's probably about to burst. What are the characteristics of a bubble? I thought that would be interesting to discuss in our webinar today. This is based on sources from Wall Street Journal article, which is called Bernanke's Bubble Laboratory. Princeton proteges of the Fed chief studied the economics of manias. It was written by Justin Lahart, I'm sorry if I mispronounce it, in a Wall Street Journal in 2008, a couple of years ago. And then a research note by the Bank of New York Mellon Research in London, written by Neil Miller, the currency strategist there yesterday, brought my attention to these characteristics of a bubble. So I thought that it would be interesting if you're in a euro bubble camp, if you will, to examine the characteristics. Number one, characteristics of a bubble, according to Bernanke's, Mr. Bernanke, the Fed chairman, a few years ago, has assembled a team of Princeton scholars in Princeton University here in the U.S. to study the economics of a bubble, the characteristics of a bubble. And here are the main points and the conclusions that these scholars and researchers have come up with. Number one, bubbles emerge at times when investors profoundly disagree about the significance of a big economic development such as electricity and autos in the 1920s, the internet in the 1990s, the growth of China and India in most recent days. Because it's so much harder to bet on prices going down than up, the bullish investors dominate the market. At the outset, the surge in values of related businesses and goods is often justified, but then it detaches from reality at the later point. Number two, once they get going, financial bubbles are marked by huge increases in trading, making them easier to identify. We're recently seeing increased volatility with currency exchange rates, actually the highest in the last couple of years, historically, if I'm not mistaken, volatilities that we have witnessed. The euro, for example, has come recently just toward the end of 2009. It was trading at or even 2008, it was trading at an all-time high, and it has come down to a 4-year low just in the beginning of the summer, if you recall, below $1.19. That's a huge volatile moves up and down for that currency pair. So once they get going, financial bubbles are marked by huge increase in trading, making them easier to identify. Number three, manias can persist even though many smart people suspect a bubble because not one of them has the firepower to successfully attack it. Only when spectacle investors act simultaneously, a moment impossible to predict, that is when the bubble pops. The problem is that the moment is impossible to predict when the bubble will pop. Number four, investors dogmatically believe that they are right and that those who differ are wrong. And as one set of investors becomes less optimistic, another one takes its place, and then investors figure that they can always sell at a higher price, and that view leads to even more trading, and at the extreme, stock prices or any kind of prices of a bubble go beyond any individual investor's fundamental valuation. And then, at some point in the bubble, the optimist enthusiasm runs its course, prices turn down. At that point, there is an expectation that investors who are skeptical might see prices as more reasonable and then start buying at lower prices. But if these investors don't start buying at these lower prices, then that's a signal that prices have gotten way too high and then we get to see them tumble and the bubble pops. So in the article, they show three prices, and in comparison, they show the Las Vegas home prices between August 2001 and February 2008, and with the peak being August 2006 in Las Vegas home prices. Oil prices that they say at the time when they published this, they haven't really popped in 2007, weren't they? 2008, something like that. They reached about $150 a barrel. Now that chart would look a little bit different. We would see the pullback in oil prices as well, as far as long-term development is concerned. And then this is the bubble chart for the NASDAQ from March 1995 through 2002, the so-called internet tech bubble, if you will, where they soar up here and then the bubble bursts and the reversal occurs. So these are some of the characteristics of the bubble, especially if we could use the NASDAQ chart here for you to compare. Las Vegas home price is still, sort of in a reversal, obviously, down from the peak, but not completely all the way down to levels from August of 2009. So now that we know what a chart of a bubble that's burst look like, let's go ahead and take a look at the euro-dollar chart, and that would be the month chart of the euro-dollar pair. So when we take a look at this chart, do we see the similarity? We can see the euro rallying up, 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 up. This is from pretty much the beginning of the last decade. And for the majority of the years between 2000 and 2010, the euro has been in an uptrend versus the US dollar. It looks like it reached a peak here at the dollar, a little bit above $1.60. And then we could see prices now coming down from the peak. So now is that just the bubble burst? And then the euro would reverse back to parity with the US dollar and maybe even below parity? If you recall, in 2001, the euro was actually trading below 85 cents per US dollar. But is that the bubble bursting, or is that simply a price correction for the euro of the multi-year bullish trend that the euro has had? A welcome price correction may be due. So if this is a welcome price correction, has the euro managed to reach about 50% of the previous gain that the euro had? Approximately the 50% retracement level would be around here. And it looks like we did manage to reach it right here in the month of June, wasn't it? When the euro reached a low below $1.20, below $1.19 or so. $1.16.5 were the previous lows for the euro dollar pair in 2005, wasn't it? I think somewhere around that time. $1.16 area. And we still haven't reached that. But what's interesting to note also here that if this were to be the reversal and a burst of the euro bubble, then if this should be a decline here, then the definition of a downtrend of this decline, and that's something that we need to watch for in the fourth quarter of 2010, obviously. The definition of a downtrend is lower lows and lower highs. So far, each new low has been lower than the previous low. And also each new high, at least so far, has been lower than the previous high. That's the definition of a downtrend. So if the euro downtrend and reversal, if there was supposedly a bubble that has popped a couple of years ago for the euro, if that should be the case and that bearish trend should continue, in the fourth quarter of 2010, we'll have to watch for the euro to continue to make lower lows and lower highs. These previous lows here were a little bit below $1.25. The euro moved higher to about a little bit above $1.50. We know that the high in 2009 was $1.51.41, if I'm not mistaken, which obviously is lower than $1.60. After that high was reached, which is a lower high, the euro continued lower with a lower low, which was below $1.19. That is a lower low below the previous lows. And then as the euro now is going higher, obviously it is correcting some of these losses. As it's going higher, what we need to watch in a fourth quarter is whether the euro will stay below $1.5141. If it does stay below $1.5141, then that bearish trend would still be intact. If the euro, however, approaches and breaks above that high, which was the 2009 high at the $1.5141, then we could see, in my opinion, at that time, the resumption of the euro's bullish trend versus the US dollar from the previous decade. And this is where I think that the euro's developments in a fourth quarter, the developments with the euro-dollar pair in a fourth quarter would be so crucial for the future, potentially multi-year trend for this currency pair. And we are now, as of today, overshooting a very, very important price level in my quarters theory methodology, which I call the large quarter point at $1.40. And also it is the major whole number at the $1.40. Why is the $1.40 level so crucial and so important, in my opinion? Well, here's why. As I explained in my quarters theory book, these major whole numbers, such as $1.30, $1.40, $1.50, are important critical junctions that mark the end of a previous 1,000 pip range and the beginning of a brand new 1,000 pip range. With my quarters theory, I divide these 1,000 pip ranges. Of course, between these major whole numbers like $1.30 and $1.40 or $1.40 and $1.50, you have 10 cents distance between them. In terms of pips or price interest points, that is a clearly defined range of 1,000 pips. So with the quarters theory, I divide these 1,000 pip ranges into 4 equal parts or 4 large quarters of 250 pips each. And I propose with the quarters theory that prices don't move randomly and chaotically, but rather there is a organization in price moves. And I propose that every significant price move occurs from one large quarter point targeting another large quarter point in a systematic effort to complete these large quarters from one large quarter point to the next. But I also propose that there is a fluidity and organization in price moves, not only to complete the large quarters of these individual large quarter points, but there's also an organized systematic effort for prices to ultimately complete these entire 1,000 pip ranges. And as we witnessed recently with the euro-dollar pair, we have now, as of today, had the completion of the entire 1,000 pip range between $1.30 and $1.40. The $1.40 level, therefore, is going to be a very crucial, very important junction, because it is the price level that signals the end of the previous 1,000 pip range between $1.30 and $1.40, and then at the same time, the beginning of a new 1,000 pip range. That will be the very important, crucial 1,000 pip range for the euro-dollar pair between $1.40 and $1.50. Because if that 1,000 pip range is successfully completed, if the euro moves and transitions decisively into the $1.40s, above $1.40 from the $1.30s into the $1.40s, then that would be the first clue potentially for us. If there should be, of course, a decisive transition. I mean, as of today, the euro has overshot the $1.40 level, but that does not constitute a decisive 1,000 pip range transition. The euro must make further headways above $1.40. We might even see the euro pushing $1.40. And certainly, we witnessed that as of today with the euro even overshooting a little bit above $1.40. But what we're now witnessing is perhaps the first red flag, if you will, or a warning sign. Now, throughout my years of experience, I have established a rule, which I also explain in my book, The Quarters Theory. Looking at these Fibonacci retracement levels, what I personally call normal Fibonacci retracement is anywhere between, obviously, the 38.2, 50 to 61.8% Fibonacci retracement. So as long as the Fibonacci retracements are within these ranges, and it could go even up to 61.8%, I consider that as a normal retracement. But a red flag for me always is when the 61.8% retracement level is being exceeded. Now, why would that be a red flag? Obviously, we have the 76 or whatever next percentage of retracement according to the Fibonacci percentages that could be challenged. That is definitely a strong potential there. Now, especially that the euro is breaking above the 61.8% level. But what is also a move above the 61.8% retracement, to me is a red flag also because it increases the odds for a larger price correction and a possibly not even just larger price correction, but even a complete 100% retracement. Well, what would be that exact 100% retracement level? It would be the high from 2009 at the $1.5141. And as I mentioned earlier, if we get to see that retracement continuing further above the 61.8 retracement level, above $1.40, combined with a decisive successful transition of the euro-dollar exchange rate from the $1.30s into the $1.40s, and if the euro-dollar pair were to stay into the $1.40s, then that would be some of the first clues, I think, that we can see in the days ahead into the fourth quarter of 2010 of something more serious that could be brewing for the euro against the US dollar than just a price correction. It is still just a price correction, but this is something that we really need to carefully watch for in the days and weeks and even months ahead, especially if the US data continues to deteriorate and if the Fed is perceived as offering further quantitative easing as well. What we also started witnessing in a third quarter and still continues into the fourth quarter of 2010 is the resurgence of the US dollar as the preferred currency for the so-called carry trades. With record low interest rates here in the United States and the Fed clearly not in any position to start raising rates anytime soon, the US dollar has quickly managed to get that status as a preferred currency for carry trades. And some of the confirmation that we got for the resurgence of the US dollar carry trade in the third quarter of 2010, which could obviously continue in the fourth quarter of 2010 if the Fed continues to keep rates low, is that resurgence of the US dollar carry trade was confirmed, in my opinion, by the rally that the higher yielding commodity currency, the Australian dollar, has managed to stage versus the US dollar. And a lot of you who do follow the developments with the Aussie versus the US dollar currency pair in the last several months would know what I'm talking about. Here's an example of it. As I mentioned earlier, the Aussie was under pressure, but it found the bottom in the beginning of June, and it had a quick reversal and still continues to rally against the US dollar. Now I should wrap it up in the next 2 minutes, so let me give you a list of what are some of the factors that could provide the clues for the things to come in the fourth quarter of 2010. What are the factors that will drive the trends for the dollar, the euro, and other currency majors in the fourth quarter? I have put a list for you of 10 factors to watch in the fourth quarter of 2010. Sorry about the typo there. Number one, sovereign debt crisis in the Eurozone. It's not completely over yet, but it's on the back burner for now. Worldwide economy slowing down. Fiscal austerity, monetary policies of major central banks interest rates, yield differentials, whether the U.S. dollar carry trade will continue into the fourth quarter, which has started again in the third quarter. As we start every new quarter, the U.S. and the G7 corporate earnings should be closely watched as well. We are seeing now foreign exchange reserve diversification happening again. A lot of countries, emerging economies, are attempting to keep their currencies low and are using U.S. dollars. They're buying U.S. dollars, according to some reports on Bloomberg in the last few weeks. Some hedge funds managers that monitor the flows have been talking about this. Foreign exchange reserve managers buying U.S. dollars, using them to intervene to weaken their own currencies. But on the other hand, they don't want to hold the U.S. dollar, so immediately they dump their U.S. dollar holdings, the extra U.S. dollars, and purchase other currencies. So that would be one of the reasons why we continue to see for 19 straight days the euro rallying against the U.S. dollar and the U.S. dollar being weak across the board. And last but not least, maybe a lot of foreign viewers are not aware of that, but we are going to have a midterm election for the House and Senate here in the U.S. And that's a very important month of November ahead of us. If there's any change in the dynamics there as far as the geopolitical developments here in the U.S., that is important to watch as well. What would be the outcome of the election in November? So these are the top 10 factors that we're going to watch in the fourth quarter, and I will follow up with you in the next 3 months from now, to talk about as to what we can expect in the first quarter of 2011. Thank you all very much for joining me today. If you would like to keep in touch, make sure to go to my website, allthingsforex.com, and listen to the All Things Forex live daily broadcast, which, by the way, is also available on fx3.com every day. I publish it there also. Thank you again, and thank you to our friends from FX3. Thank you for joining me. Have a great afternoon. Happy trading, and I'll see you again soon.